Excellent. So the BOSS acronym is something, something we came up with. It's basically, I love acronyms because it kind of helps you remember what you should be focusing on. And I use them quite often, actually. And this is obviously one of my favorites. You want to become the boss of your own life, of your own strategy. And the key to being the boss, in my opinion, when it comes to options trading, is to have the best option strategy selection. It is such an overlooked topic. If you want to read about an option, you could always read a book, right? I mean, we provide education on options, obviously. We talk about strategy, we talk about actionable trades, but to come up with the right strategy is very, very important. And I've developed a system over the years that's very, very effective. And I'm going to share that with you today and a little bit how we teach it. So to become the options boss, you want to know which strategy to use for the current market conditions. So I have a step-by-step approach. It's basically a 4-step approach that allows you to strategize and come up with this outcome. So let me just move on here. So just a quick disclaimer, obviously, the authors of this, we're not registered advisors or broker dealers. We're not here to give advice or make specific recommendations. Everything is here for educational purposes only. What I tell my students and, what I tell everybody here is, we offer education and you have to be responsible, ideally, ultimately for your own trading future and your own trading plan. So we do help you develop your own trading plan and your own risk management and everything else. But ultimately you must take always responsibility for your actions, okay? So a little bit about my background. My full name is John Napolitano. I am a New York City native, so you might catch a little bit of an accent here and there. I graduated from Fordham University in 1996, right around the time of the dot-com bubble. So I came up through Wall Street during a very interesting time. I first started working in the asset management industry, and I consider myself very blessed. I worked for some of the best money managers in the business. So I started on the institutional side, first in operations, and I was a junior trader, and I kind of worked my way up. And basically, I got onto the trading desk sometime in the late 1990s, where I was trading stuff like currencies and some equities and some fixed income products. I got to know the business really well. And during this time, I went to school and finished my MBA. So I have my MBA in finance. I graduated in 2000 from night school, also in New York. So from there, I kind of accelerated into the trading desk. I became a VP of trading, and I ended up becoming the head trader of a global asset manager. And at our peak, we had $40 billion under management. So it was during this time where I really got familiar with, options trading, because obviously, when you're managing all that money, you have to be very, very careful as to hedge and what strategies to use. So I learned options from some of the best people in the business. So since 2016, I've basically been trading my own capital, and I've partnered with Pete because I feel there is a big shortage of good education out there. And I really want to try to make an impact on people as far as, the right way to handle options, the right way to trade, and the right strategies to use. So here I am. A little bit about my background. So Options Trading Pro, predictable profits in just 4 steps. So there's steps within the 4 steps, but we're going to kind of go over it step by step today. Obviously, this is just a, short webinar, so we can't, I can't show you everything in just 40 short minutes or so, but I'm going to give you a little bit of a taste of the overall process. So the first step 1, you have to determine the right size of profits to target. There's a couple of things you have to do here. How to put the right size position on every single time, that you'll always make the most money available at every moment. So there's a couple of things you have to do. Now, I mentioned acronyms. When it comes to the right size, another acronym that I love to use is something called TESTS. So it's the plural of tests, right? So you have to know your target, you have to know your entry, you have to know your stop, you have to know your timing, you have to know how long you plan on being in a trade before you get into it, whether it be a 1-minute scalp trade if you're a very quick in and out day trader, or like me, I tend to swing trade. I hold things for several weeks. Sometimes I hold things for several months. So you have to know your time frame. And the final S in tests is your sizing. How big of a risk unit are you going to put on? So I talk about risk units in one of our classes, how to determine what your optimal risk unit is based on the size of your account and how many different trades are you putting on. Now, there are things you can do to maximize the size of your account. And one of the things we do in step one is to analyze the overall market and determine how many bullish trades and how many bearish trades you have to put on at any given time. Okay, so I'm going to move over one of my screens here. Let me just so here's my first step. I'm gonna share this with you. I'm gonna slide this over here. I'm just on FinViz. It's a really cool website, by the way, that we use all the time. It's free, finviz.com. It's just a great tool that we use here. But one of the first things I do, like on a Sunday night, when it's quiet out and everything like that, before the market opens, sometimes on Monday morning, if I have plans on Sunday evenings, what I'll do is I'll sit back and I'll analyze the markets. So I look at the SPY, I look at the QQQ, and I look at the Dow Jones. Sometimes I'll even look at the Russell. I'll look at IWM as well. So just to give you a little taste of what we do here, I look at moving averages, and now I'm not making any trading decisions right now. What I'm basically doing is my first step in my analysis of being the boss. I want to know what the market is telling me. I want to give the market an overall grade so I can determine what I should be doing for the week. So I start with the market because there is something out there called this. It's basically called the 60-20-20 rule. Some people call it the 60-30, the 50-30-20 rule. But basically, 60% of the movement of any stock has to do with how the market itself is doing. Okay, on any given day, forget about news or earnings. I'm talking about like any given typical day. You should really be paying attention to what the overall market's doing, because you could have a very bullish trade, a fantastic idea, and you know what? If the market rolls over, you're not going to make any money that day, obviously. Same thing, the other 20% has to do with the sector. So you have to pay attention to the sector, which we're going to talk about in our step two. If the whole sector decides to rotate on you, like today, energy rolled over, you could find the best energy stock in that group, and energy completely was negative today. So, this type of analysis is very, very important to traders, and it's often overlooked. So what I do is I look at the market, I look at moving averages, and I determine, so here's SPY. I determined that, we look like we're in an early stage uptrend. We're above our moving averages, and the 20-day moving average is crisscrossing the 50. So we talk about secondary indicators in our classes. We go over all that stuff. They're all, these are things we incorporate in our strategy. But basically, I have to give the market a grade. Now, we do have some overhead resistance here. So, I'm a little bit apprehensive to give the market like a B+ or an A- or anything like that. But I think I'm going to give it a solid B, because it's off its lows, and basically it's showing some relative strength. Even yesterday, I was talking about this yesterday in my coaching call. We do weekly coaching calls for our annual members. And basically I said, listen, you had missiles go off in Poland, and nobody really knew what was going on. And the market, even though it only sold off about 1%, if that happened a year ago, forget about it. You would have been down 5%. So the whole thing is that the market held up pretty resiliently. We're still above our moving averages. So I have to give the market some credit for the behavior that it had. Even today, even though we had a down day, it was pretty orderly. Nothing really sold off too hard, with the exception of maybe Target because of earnings. But other than that, we held up pretty darn well. Now, the NASDAQ, on the other hand, which is the QQQs, is struggling a little bit more. If you'll notice, the chart doesn't look as good. If you'll notice, the 20-day moving average did not cross the 50-day moving average quite yet. So the NASDAQ's struggling. It's still above here. So, if I gave the, let's say, the S&P a B, I would give I'd give QQQ a B-, right? So obviously, if I'm going to be looking for opportunity, I'm already giving you guys clues as to where I'm going to be looking. I'm not going to be looking in the technology sector. I'm not going to be looking in the NASDAQ sector at all, because it's showing relative weakness compared to the S&P. Now, out of all three, which chart looks the best? Well, the Dow looks the best, believe it or not. That's not always the case, right? But look at the move the Dow had. DIA is the Dow ETF. And if you'll notice, you have these massive You have these massive moves, and even today, like we were pretty much flat, and we were actually positive for like a good part of the day today, when the rest of the market was pretty much negative, especially the Qs, especially the Nasdaq. So if I had to pick an area, if you had to kind of take a bet on like what group or what area you should be looking at, step one is complete. You said to yourself, okay, you know what? I am going to look in these more boring type names. Me and Pete were joking earlier before some of you joined the call, that we're looking at things like McDonald's. I'm looking at stuff like Honeywell, 3M, Boeing. I'm looking at the boring stuff that a lot of people overlook. I think Pete had mentioned he was looking at General Electric. I mean, these are names that like are snoozers, you know what I mean? But that just happens to be what is showing relative strength. Now, when it comes to looking for bears, now remember, we're options traders. So as an options trader, you could go up, down, or even sideways. So I am going to be looking at, if I'm going to be adding bear trades, I'm going to be looking in the technology sector, right? Because that shows relative weakness. So now I know, I already have a clue as to where to look. I know where to look for my bulls, and I know where to look for my bears. So that kind of completes step one. There's much more detail that I go into in my classes, but that's just a little bit of a taste of the step one. You want to have an overall grade going into Monday morning. You want to have a position. It's okay to be wrong, by the way, right? But you have to have some sort of an idea as to where you're going to be looking. There's a universe of 10,000 stocks out there, and you obviously want to find the best opportunity. So that gives you the clues that you need, okay? I just limited your choices, by the way. Like if you kind of look at what I told you, I said the Dow is really, where the relative strength is. That basically means industrials, healthcare, and financials, and maybe some consumer defensives. So I just took a universe of 10,000 names and pretty much knocked it down to like, maybe 1,000 or 2,000 names, which is still a lot of homework to do, don't get me wrong. But that's basically what we're doing here. The next thing you want to do is determine the right rotation and the relative strength. So we already started doing that, but what I'm going to do is take it a step further, and I'm going to start grading the actual sectors so we could figure out how to grade each trade to avoid predictions and ride the wave. So keep in mind, we're going to do the same process, but one of the things, I'm going to bring this chart back really quick, but one of the things I'm going to do now is I'm going to turn this into like a two chart picture here, and I'm going to keep SPY here. And what I'm going to do over here is I'm not going to go through all 10 in the interest of time, but I will write them down for you. So if you want to know what each sector is, I always leave one out. Let me see. So it's XLU is the utility sector, right? Then we have XLY. Then we have XLC. XLY is consumer, XLC is communications. Then we have XLV, which is healthcare. Don't ask me who initialed these. XLF is financials. XLI is industrials. That's 1, 2, 3, 4, 5, 6. Then we have XLK is technology. Then we have XLRE, which is real estate. We have XLB, basic materials, which is metals and copper and all that good stuff. Then we have XLE, which is finally energy. So I think I have all of them here. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Didn't leave any out this time. So I look at all these 10, and this is what I do. I have SPY here. We already kind of know what SPY is. It's a B. It's around a B, right? How does utilities look? Well, utilities obviously has not crisscrossed yet like this one did. So utilities, if SPY was, let's say, a B, I would have to give XLU like maybe a C plus, right? Now let me show you what a really good sector looks like. Take a look at energy and look at how fantastic this looks. I know we had a weak day in energy today, but it's just pulling back to its moving average. It really is kind of parabolic compared to SPY. Now, let me show you what technology, let me show you industrials, which basically makes up the Dow Jones. Look how fantastic that chart looks if you kind of compare these two. So this is what I'm talking about. What you're looking for in step 2 is relative strength. So I just took your universe of 2,000 names, and now I kind of whittled it down to maybe a few hundred, because basically I'm telling you, you should be looking for your bulls in the industrial sector, right? Perhaps the energy sector, if it pulls back a little bit more. It's a little bit overextended, right? We'll talk about that too in our classes. But basically, you want to try to find things that kind of pull back but are still in an uptrend. So look how fantastic this looks. Healthcare is a little choppy, but it's still way above its averages. It's kind of chopping around, but if it holds this average and this average kind of catches up a little bit, that is a fantastic setup. So where are we looking? We're looking in healthcare. We're looking in energy. We're looking in industrials. Those are like my three favorite sectors right now. Where are the garbage, right? You want to look for the garbagey sectors too, because don't forget, you want to be balanced when you're trading options. One of the things that I talk about all the time is you don't want to just have a whole bunch of bullish trades on, even if you pick the right sector. You want to have a balance. You want to have a little bit of always a balanced portfolio between your bulls and your bears. If I give the overall market a B, that means I expect the market to not really perform that great. I expect it to kind of chop around, maybe go a little bit higher. That's kind of what I expect based on what the charts and what everything is telling me, right? So that means that I'm not going to have like 10 bullish trades. I'm going to have maybe 6 or maybe 5. And I'm also going to have 4 or 3 bearish trades at the same time. So I'm going to have call trades and put trades and spread trades, and all the stuff that we teach it's all going to be together, and we're going to do it in a very methodical, intelligent way, right? So that is the whole plan. Now look how terrible the XLC looks. This is in a downtrend, and it looks like it's just it actually performed a little bit of a bear rally here. So if I'm going to be going short, guess what this is kind of signaling me to go short, because it's already starting to roll over a little bit. So the communication sector is probably one of the worst. So, I mean, what's in the communication sector? Well, you got Disney, you got Meta, you got Google, you got Twitter, you got, some of the, some of the news companies and stuff like that, like T-Mobile, Comcast, names like that. Netflix is in there. So those are the kind of areas where I'm going to be a little bit bearish, okay? So now I know exactly where I'm looking. I know exactly what I'm doing, and I'm only on step 2, right? I haven't even figured out yet really what strategy to use yet, right? That's kind of another thing we're going to talk about next, okay? So that takes care of step number 2. Now, remember, there's a lot more detail in this. You're going to use secondary indicators. You're going to grade the market based on certain criteria. Like I said, we don't have all the time in the world to go over every single factor, but as you can see, it's a pretty methodical approach to what to decide. And I've already limited your choices down to maybe a couple of hundred names, down from 10,000 different names. Okay, so that's step 2. We kind of know what wave to ride. We're going to be riding on the energy wave, the healthcare wave, and the industrial wave, and we're going to take the wave down in the communication sector and possibly technology, right? So the next thing you have to do as an option trader is you have to determine what side of volatility you are on. So one of the things we talk about in our classes is when you trade a stock, you have the luxury of holding on to it forever. You can leave a stock to your grandkids if you want. However, when you trade an option, you have an expiration date. Every option has a shelf life. So basically, what you have to do when you're trading options is determine the right situation, the right expiration, strike, and strategy to use. And a lot of that has to do with step 3, which determines what side is volatility telling us. What is happening with volatility? So there are 3 main things I look for when it comes to volatility, and I will share them with you right now. Obviously, the first one is the VIX. I take a look. I'm going to pull up the VIX chart right now. I'm going to move this over, and I am going to show you that the VIX actually didn't really do much today. It kind of flattish. Now, yesterday it did kind of spike, right? If you look here, the volatility index spiked and it wicked out. It kind of candled down here a little bit. So the VIX has been very complacent. Now that tells me that I should be a little bit more on the bullish side, because as you can see, the VIX kind of collapsed here. And that's a very bullish sign. So for those of you who aren't familiar with what the VIX is, it is basically the fear gauge. You might hear it on TV or on CNBC a lot, but basically it measures the put-call ratio of the S&P 500. And what does that tell me? Well, if people are out there buying puts, that means they're bearish, or they're buying insurance, which means they're short-term bearish and they're trying to protect their portfolios. So if institutions are causing that to happen, the VIX is going to spike. The VIX does not like uncertainty, okay? The VIX can handle a down day or a down market. What really causes the VIX to spike are things called unknown unknowns, things that kind of come out of nowhere, right? Kind of like a war in Ukraine, right? Kind of like, we kind of knew it might happen, but then it did happen and everybody freaked out. Kind of like COVID-19. Those are unknown unknowns where people freak out, and there's obviously a reason to freak out, and the VIX tends to spike. So let me just show you really quick, what the VIX looked like back during COVID-19. Check out this big spike it had all the way up to 80. It was terrible. And ever since then, it's been elevated. In case you know, I'm on a weekly chart right now, but look how it used to be. It used to be under 20, used to be considered kind of normal. Anything above 20 used to be considered elevated. But ever since COVID came, 25 is like the new 20. So 25, I would say, is kind of like, considered. Anything above 24, 25 is kind of elevated. Anything above 30 is kind of like, people are getting concerned. And anything above 40, as you can see right here, is you start to get into like freak out territory, okay? So when you get capitulation, when the markets completely roll over, the wheels come off the bus, there's all this bad news, all this stuff going on, the VIX spikes. And if you'll notice, the VIX tends to spike and pull back. It tends to spike and pull back, and so on and so forth. But right now, the VIX is trending lower. So that tells me that, there's a little bit of complacency going on. There's a little bit of year end. Everybody's kind of just chilling out. And it doesn't look like there's any major panic going on. So that's a good thing. And that tells me, now keep in mind, now back to options. Why do I care about the VIX? Well, volatility, overall market volatility, goes into options pricing. When you're buying an option premium, when you're paying an option, when you're buying a contract, the price component of that option has to do with the underlying asset, but it also has to do with what the overall market is telling you, what the VIX is. When VIX is elevated, options are expensive. And when the VIX is not elevated, options are cheaper, right? So let me ask you this. If the VIX is elevated and options are cheap, should you be buying options or should you be selling options? You tell me, right? That's an important thing to understand. No, you should be selling options, Joseph. If the VIX is high, right? If the VIX is high and it's elevated, you should be a seller of options, right? Because obviously, if anything in life is expensive, you want to be a seller. You don't want to buy something when it's expensive, right? So when VIX is not elevated is when you want to be a buyer. So looking at the VIX is a very important exercise because it tells you right away, basically, are not any option, whether you're buying puts or calls, it doesn't even make a difference. This tells you whether options are expensive or whether they're not, okay? And a lot of people overlook this step. Now, this is basically telling me that the VIX is somewhat elevated, but it's okay, right? It's off its highs of 32 and basically it's at 25. So it's not great, but it's okay. It's okay to just buy options right now. It's not great. It's not perfect, but it's not super duper expensive where, it makes no sense to buy options at all. Okay. I hope that makes sense. So I kind of use 25 as my gauge. If it goes above 30, I start to be more of an option seller. So here's the thing with options, okay? For those of you who are brand new to options, when you buy a stock, you have two choices. You could either go long or you can go short. You could either go long, meaning, buy and hold, right? And then sell and make money, hopefully, right? Or you can go short, meaning you buy something you don't have. You're selling a stock that you don't own and you're covering it to make a profit. That is shorting, right? You could look that up. You could look that up on the side. I don't want to get too far into shorting in this webinar, but basically you're betting against the market, right? With options, it's the same thing. When you're buying a call, it's the same thing as going long. When you're buying a put, it's the same thing as going short. But there's four ways to express yourself with options. You can buy a call, which is bullish, or you can sell a call, which is bearish. Those are two things you can do. You can buy a put, which is bearish, or you can sell a put, which is bullish. So in options world, you have four choices, not two, okay? And we'll talk about all this in our classes. We'll get really into the weeds if you spend some more time with us. But basically, those are your four choices. Those four choices are the building blocks of everything you're going to do. Whether it's a one-leg option strategy, whether it's a two-leg option strategy, a three-leg option strategy, or even a four-leg option strategy, okay? That will determine whether you are a buyer or a seller of options, okay? So remember, when VIX is high, you want to be a net seller. When the VIX is low, you generally want to be a net buyer, okay? So that concludes pretty much step 3, almost, okay? One more thing we have to look at. Let me go to the other screen here. I'm going to pull up, let me pull up my Thinkorswim account. I am just going to slide this over. Bear with me one second. Okay. There we go. All right. So for those of you who use Thinkorswim, this is great, but you don't have to be an expert in Thinkorswim to check this out. I'm just going to show you a quick option chain. And basically, when you look at options, one of the things you want to look at is implied volatility. So I have Boeing up here right now, and I'm going to go out about a month to December 16th, which is the option expiration, which is the monthly option expiration. This is called an option chain. It gives you the price of the option contract right here. Here's the bid and here's the offer. And this is going over to December 16th. Now, if you'll notice, the implied volatility is 40% or 41% for these options, right? Now, let me show you something a little bit different. Let me show you maybe, let's take a look at Target because they had earnings today. I'm going to go to the options from today and look at the elevated options here. Check out the implied volatility of Target. I just showed you Boeing. Boeing had an implied volatility of 40%. Check out 93%, 78%, 87%. When you start seeing numbers like that, especially on a boring retail stock like Target, that's telling you that these options are inflated, which makes perfect sense because Target reported earnings and there was a lot of uncertainty as to the price action today, right? So the second thing you want to look at when you're deciding on whether to be an option buyer or an option seller is implied volatility compared to its historical volatility. You're going to compare those and determine, okay, what's going on here? Is the volatility expensive or is the volatility low? That's the third thing you have to do. The second thing you have to do. The other and final part of step 3 is what you want to do is when you're looking at any stock, let me just put FinViz back on here. What you want to do is, I'm going to go back to Boeing really quick. What you want to do down here, let's see, I'm going to just add it really quick. Let me get rid of all these things. We don't need all of these. These are all secondary indicators that you'll learn, but we don't need to look at them right this second. What I am going to do here is I am going to put average true range up here. And if you'll look, ATR is basically the personality of the individual stock. So Boeing's average range tends to be $6 a day. You see the 616 right here. So basically, Boeing tends to move. Now, it doesn't tell you which direction it's going to move. It just says, the general range of Boeing is about $6, okay? But if you look back in March or April, the ATR back in March and April was $8.70. Well, what the heck happened back then? Well, Boeing was falling off back then, and it had a little bit of a spill. So maybe, the volatility was increasing. So again, it all goes back to volatility. If the ATR is historically low, that means your options premiums will be cheaper. If volatility is low, if the VIX is low, your options premiums will be cheaper. If implied volatility is low, your options premiums will be cheaper. If those 3 factors are not cheap, then you have to consider becoming a credit trader. You're going to be not buying, you're going to be a net seller of options, okay? And a lot of new traders are afraid to go in these both directions. This is the thing we teach in our class. What you want to be able to do is be just as comfortable going, being a net buyer of an option as you are a net seller of an option. There are safe ways to do it by doing things called credit spreads, which we teach in our classes. This way you have defined risk and you have defined reward. So once you figure out that you want to, let's say, go long a certain stock, you then figure out your strategy based on step 3. Okay, so that concludes step 3. You want to determine what's going on in the volatility world. The last step you're going to do now is determine which strategy is for the most profitable outcome. So back to Boeing, now that we've done this, now why did I pick Boeing, by the way? I didn't just pull Boeing out of nowhere. Look down at what sector it's in. It's in my favorite sector, isn't it? It's in industrials. Now check out, I'm going to show you a couple of names that I looked at, before this webinar started. Boeing was one of them. Look how fantastic this looks, right? It's in this uptrend. It's pulling back a little bit. And, it might pull back a little more. It might kind of just stay up here and move sideways. There's a couple of names like this that we looked at. And 3M, MMM. Looks very similar. It pulled back a little bit more. Pulled back a little bit more here, close to the average. So that might be a good entry point if it kind of levels off and starts moving higher. Honeywell, HON, is another one. And these are all names that I looked at in the sector that look at this one had no sign. Now think about it. The market sold off today, and this stock was only down 66 basis points. So some of these stocks tend to have relative outperformance. Same thing with, we could take a look at McDonald's was another one I was looking at. That's not in industrials necessarily, but look at this. It pulled back right to the moving average, and now it's bouncing. It actually was up 1.7% today. It clearly did not get the memo today that the stock market was down, right? So these are names that are showing relative strength. That's what I want to see when I'm deciding what I want to do, okay? So let's take a look at McDonald's. We're going to do this from scratch. We're going to hold off. We're going to just keep that. We're going to earmark McDonald's here for a second, but that's basically how I'm going to start building trades. In FinViz, you can use a stock screener. And one of the screeners that we use in FinViz, you could use it on Thinkorswim. A lot of other brokerage platforms have stock screeners as well. And what you're going to do is screen for names that are in your favorite sectors. Whether you're looking at bullish ones or bearish ones, what you're going to do is start building a watch list every week. You're not going to trade the same stuff every week. What you're going to do is build a watch list based on what the market's telling you. The market is telling me I should be looking at certain sectors. I'm going to build my watch list around what the market is telling me. I hope that makes sense to everybody. And that is what we're going to do. So obviously industrials I kind of picked on so far for this webinar, but you could look at financials, you could look at healthcare, you could look at energy, and all these names, you'll be able to find a good opportunity on the long side. On the short side, communications, technology, so on and so forth. And we do have a screening class in our program, in our boot camp as well, because screening for stocks is extremely important. So once you've completed all those steps and you actually screen for names, now you're going to determine what option strategy you want to do. And that concludes the 4th step. So we're going to actually create a trade with this process. So I kind of walked you through this process already, and now we're kind of at the last step. So let's go ahead and do that. Just as a quick recap, we're going to determine the right size of the profits to target. We're going to perform top-down analysis, which I just showed you. We're going to determine the right rotation and the right relative strength, and we're going to grade each sector. So I didn't go through every single sector with you. You don't have to do that every day, by the way. I usually look at sectors, like I said, on Sunday. I'll look at them again, maybe midweek, to make sure that to make sure nothing's changed. I give a mid-cap recap, by the way, a midweek recap, by the way, in our Discord channel. And then basically, then I determine what the volatility situation is, whether, what's going on with the VIX and so on and so forth, ATR and implied volatility of the stock that I'm looking at. Step 4, determine the right strategy based on what's going on. And sometimes there's more than one. If you see some of my trade alerts, you'll notice that a lot of times in the boot camp and in the Discord channel to our annual members, I say, listen, if you want to express yourself a different way than me, that's okay. When I give an actionable trade to people, what I say is, listen, you might look at McDonald's and say, you know what? I don't think it's going to get past $279, right? Take a look at this, this high that it had here. It pulled back, and now it looks like it wants to maybe test that again. So you might be in the camp that says, you know what? I think McDonald's is, it looks like it might want to go higher. It did bounce off its moving average, but I don't think it's going to get past 279. I think it's going to roll right back over again. You might be in that camp, and that means you're going to create a different trade than me, okay? I might be super bullish on McDonald's. I might say, you know what? I really like the way this volume looks. I think it's in a really strong sector. I'm going to just buy straight calls. The volatility is low, so I'm comfortable just buying straight calls. I don't need to be an option seller. I just want to be a net buyer. I'm going to buy straight calls. Or you might decide to do something a little more creative, which I'm going to show you next. But either way, that is what you have to determine in your final step. Like what action are you going to take? You want to be long, but what option strategy are you going to use? So are you going to use a straight call? Are you going to use a vertical debit spread? Are you going to use a diagonal credit? Are you going to use a diagonal debit spread? Are you going to do a credit spread because volatility is high? These are things you have to determine at the very end, and that's what we're doing right now, okay? We've already done all the other analysis. So in our classes, we talk about all these strategies, and we offer actionable trades based on, what the charts are telling us and what the markets, are telling us. And you might want to be more aggressive and do a different trade, and that's perfectly fine. There's no what's great about options, which a lot of people don't realize, is there's lots of different ways to express yourself. And there's lots of different ways that you could potentially be profitable. What I try to do is I try to maximize my edge and try to find the best option strategy selection. I try to be the boss of this because that is the key. And in this case, this particular situation with McDonald's, I'm going to be bullish, obviously, because it bounced off its moving average and it looks like it wants to go higher. Now, the question is, do I think it's going to break and make a new high? Well, I'm not sure. The market, I gave the market, keep in mind, I gave the market an overall B average, right? I don't have an A plus on the market. If I had an A plus on the market and I saw a stock that looked like this, I would probably just buy a straight call option and let it ride, right? Let it just keep ripping higher and have unlimited. When you buy a straight call, by the way, you have unlimited reward, right? So that's kind of what you're thinking. But if the overall market is only giving you a B, I'm going to be a little more cautious. What I'm going to do to execute a trade like this is I'm going to say, well, I want to buy something that's in the money. We're going to talk about moneyness in our classes too. What is the difference between at the money, in the money, and out of the money options? It's very important to pick the right strategy and the right strike and the right expiration. Because of time decay, you also want to pick something that does not just melt away on you too fast, right? Now, McDonald's, based on the ATR, it trades about $5 a day. So for it to get to this area, for it to get to like this 280 area here, this is my initial setup. So the first leg of my trade, I might think it's going to go to this area. And then, you know what? Maybe you're absolutely right. Maybe it's going to bounce here and maybe it's going to play this game for a little while, right? Stocks don't go straight up. We know that, especially in a choppy market that we're in right now. So it might play this game for a little while, right? And then it might do this, and then it might tighten up a little bit. And then finally, after it gathers a little bit of momentum, right? After it kind of like sits here for a little while, then it'll make a push maybe closer to 290 or 285 or so on and so forth, right? I do like the volume, by the way. That's always a plus when you see, when you see increased volume on the way up like this. This is kind of cool. This volume bar here, and even here. It did have a big volume bar going down though, so that makes me a little bit nervous. But you know what? It's been kind of choppy, and you also have some headline risk that we had yesterday, so it's kind of understandable. So that's kind of like my setup. I think it's going to eventually break, but I think it's going to take a couple of weeks. Okay, that's my setup. So what you want to do in the case of an option situation is you want to buy in the money options. Now, I know a lot of people say, oh, buy out of the money options, they're cheaper. Or you know what, why don't you just buy the 280 strikes because that's your initial target, right? But what happens is that, you know, you're buying out of the money option. You ever hear the expression, you get what you pay for? Well, there's no other better saying that applies than with options. You get what you pay for with options. You know what I mean? When you buy an at the money or a slightly in the money option, you have a higher probability trade. So we talk about our Greeks and delta and everything else in our classes, but basically, and you'll learn that stuff in boot camp, which strategy to select and when. But basically, I'm going to go for basically maybe the 265s. I'm going to go a little bit deeper into the money. And my target, keep in mind, is 280. But here is where I'm going to kind of blow your mind a little bit. If I want to go out, let's say a month. Let's say I want my trade to work. I want to go out at least 30 days because I don't want theta decay. I don't want time decay to melt away my trade. Remember, when you buy an option, you're kind of buying an ice cube, right? You don't want it to necessarily melt away and lose money until your trade works. So what I'm going to do here is I'm going to go out a decent amount of time here. I'm going to go out at least a month, maybe even sometimes I go out even longer, but I'm going to show you what I'm going to do here. I'm going to go out to December 16th. And here they offer the 270s, which are in the money. And I'm not going to buy the straight call options. What I'm going to do is say to myself, well, how long do I think it's going to take for it to get to 280? I don't think it's going to take a month. I think if it goes up to here, maybe it'll take a couple of weeks, right? So what I'm going to do is I'm going to do a diagonal spread. So the way I'm going to handle this, and you'll learn this in boot camp, like why, you know, what is a diagonal spread exactly. But basically what I'm going to do is I'm going to buy these 270s, but I'm going to buy it with something attached to it. I'm going to buy a single call, but I'm going to sell the 280s against it. Now, why would I do that? Well, the 270s are going to be more expensive. They're about $7. The 280s, I'm going to go to December 2nd. The 280s are only $1. They're about $1.10 if you look at the spread between the bid and the ask here. So basically, I'm buying something that cost me $7, around $7, and I'm selling something against it where I'm going to take in a credit. When you sell an option, you receive a credit from the person who you bought it from. So who bought it from you, I should say. And basically, you're going to take in $1. So I just lowered the cost of my trade, didn't I? I basically bought something for $7 and I'm receiving a credit for $1 and change. So now the cost of my trade, when my total risk just went down. It went down from $7 down to like $6. So that is the plan here. Go here. I'm going to hit diagonal. The reason why it's a diagonal is because I'm using different expiration dates. I'm going to play around here and just change this to 270. And I'm going to go here. I'm going to make this December 16th. And then I'm going to sell the 280s against it. Now, here's the thing. When I sell the 280s against it, I'm not going to use December 16th. I'm going to go out to December 2nd. And I'll explain to you why. It's going to cost me $5.93. I'm going to analyze this trade. And let me, if I show you what this risk graph looks like here, this might help a little bit. Let me get rid of, I had something else going on here. Let me get rid of this. Let me see if I can get rid of all these. So this is basically what a diagonal spread looks like. If you'll notice, the risk graph here is a little crooked. And this basically tells you that your total risk here, if it goes up to 280, you're kind of capping yourself off on December 2nd. So you're expecting it, like, back to the chart here for a second. You're looking at here, you think it's going to basically bounce around and go higher, but you don't anticipate it going past 280. So basically what you want to do is give yourself some time. So that's exactly what you're doing. You're going out to December 2nd. And here's the beautiful thing about this. If December 2nd rolls around, that $1 and change is yours to keep. That's a credit, right? It expires worthless. And now you are left with, guess what? a straight call option. So at that point, there should be a little dotted line here actually, because on December 2nd, you're going to have unlimited reward potentially, right? You're going to take in that dollar, you're going to lower your cost from $7 down to $6, and you are now going to have a straight call option. So that is why I would choose the diagonal spread in that case. I chose that strategy for a reason. I chose that strategy because the volatility in McDonald's is really low. You know, I mean, look at some of this. You know, historically, it's sometimes higher than this. But if you go back to December 16th here, it's in the 90s. This is another reason why I wouldn't just buy straight calls. Historical volatility tends to be a little bit high now. The VIX is lower and ATR is low on this. So, you know, the only factor that is showing elevated volatility is the implied volatility. So that tells me I should definitely not just buy a straight call. What I really need to do is lower my cost of my trade. So I'm going to go ahead and do that diagonal spread. So that's why I decided to do a diagonal spread. These are all factors that you'll learn when you start putting together trades, when you start using the best option strategy selection. So that's it in a nutshell. That's the whole process. There's so much more that I want to show you guys. Obviously, we don't have all the time. We're kind of running out of time now, so I want to kind of move forward. But basically, these are things that we do in our coaching calls. We go over all these setups. You know, the students, obviously, all of you guys, you know, come in with ideas and questions, and we talk about them. As boot camp members, you know, you're going to get, you know, I'm going to go over that in a second, but you're going to actually have coaching calls with me. You'll have up to 4 live sessions with me where you could ask me questions, and we'll talk about what's going on and what are some of your roadblocks. You know, what are some of the things you're stumbling on, and we'll be able to work through all of those together. Okay, so. Are options trading easy? What do you guys think? I've showed you kind of all the things to look at. Now, obviously, there's a lot of stuff to know, right? So you have to look at stuff like volatility. You have to look at the Greeks and know what they mean and how they work with you or against you. Some of them work with you, some of them work against you. It depends on what strategy you're using. Then you got to look at time decay. Time is one of the Greeks, and you got to think to yourself, well, is time my friend or is time my enemy, right? When you're an option buyer, time is your enemy because you only have a limited amount of time for your trade to work. In the case of McDonald's, you know, McDonald's has to break out past 280 before December 16th. Otherwise my trade doesn't work. What is my buy premium? How much does my overall cost trade? What's my risk? What's my sell premium? Is it better to be an option seller or is it better to be an option buyer? What is the overall market doing? Am I giving it an A+ this week or am I giving it a B+ this week? What's going on, right? It is not as complicated as you think, Charlie. You know what I mean? Once you have a process in place, it is not complicated at all. There are a lot of things to be aware of, though, obviously. But with options, you have lots of choices, and it's great to have choices because that increases your probability of success. Implied volatility is something you have to be aware of. You know, whether to use calls or puts, be aware of the volatility index, expiration, covered calls, historical volatility, whether to do credit spreads or debit spreads, what sector to look in, and you know, what is the underall stocks doing in the case, right? So what's in the money, what's out of the money, and everything else. So you have to choose the right strategy. These are all things we help you with. There are a lot of things to understand with options, but the reward for trading options is mind-blowing. The potential for trading options just to manage risk. You have a defined risk, you know, it's very easy to like put together really good trades that allow you to sit through volatility and not be so worried about like how much money you have in harm's way. That's why I love options so much. It's actually, you know, people think options are risky. That's the furthest thing from the truth. They're actually less risky when you know what you're doing. Managing your risk and the proper sizing is really, really important, okay? And that's what we're here to help you with. So the 14-day boot camp is designed to help you. Exactly, Pete. You want to reduce being overwhelmed 100%. That's what we're here for. That's why we designed this program as a home study course, which will help you learn the basics first. how to put together these trades and how to be the, you're going to begin learning how to be the options trading boss. You're going to get alerts and management updates. I give trade alerts on a daily basis. And not only that, I give updates. So I talk about if a trade, starts to maybe underperform or change, or if there's something maybe we should do. I am there giving alerts every single day. We do weekly coaching calls for our annual members, but for the bootcamp members, like I said, there will be a total of 4, sometimes as many as 5 live sessions where you could basically ask me any question you want. There is one out of those 4 calls, there's one call that's dedicated just to your questions and answers, just a question and answer session. So if you guys are struggling in a certain area, I am here to help you 100%. We give midweek video updates. So like I said, I grade the market overall. Everybody should, whether you're trading stocks or options, you should definitely come from a position of, how do you feel the markets are doing? Are you bullish? Are you bearish? Sometimes that changes midweek based on what's happening in the market. So I give a midweek update. As a matter of fact, I'm going to do one when this call is over. I give midweek updates every Wednesday evening. The next thing we do is we give bonuses. So we have, besides the home study course, the trade alerts, the coaching sessions, the midweek video updates, you're going to get implementation sessions. They're designed for additional training, and they help you eliminate roadblocks. You mentioned it was confusing, but in the bonus sessions, we talk about building your screens. We talk about secondary indicators. We talk about how to build the right trades at the right time. And we go through the whole process step by step. Very hard to explain everything in a 40-minute video, obviously, right? So it's, there's the 14-day boot camp gives you plenty of time to immerse yourself in all that material. We also have Discord community. So in the Discord community, not only do you have me giving trade alerts and management updates, we have a Discord channel where other traders like yourselves are interacting with one another. So we talk in the Discord channel every day too. We talk about what strategies we're looking at. We share ideas and everything like that. So we keep in mind, you're not just signing up for a class. You're signing up for a community. You to belong to a group of like-minded people like yourself. So order flow stacking lessons from Pete will be your third bonus. So these are all things you're going to get during the 14-day trading boot camp. Okay. I know you guys had some questions. We're going to cover Q&A very, very soon. So home study is going to be broken down into modules. Now, some of you might have traded options already. Some of you might have some experience, but I encourage you to look in module 1, even though it's just an intro. It starts from the very, very beginning. Why do we trade options? What's the point of trading options when you could just trade stocks, right? We go over all the reasons why options trading is so amazing. We talk about why, what is an option? How are they developed? And what are some of the reasons why people trade options? We talk about the lingo and the terminology, in the money, out of the money, things like that. All gets covered in module 1. And then we get into what I said earlier about, well, you have 4 choices. You could be a buyer of a call, a seller of a call, a buyer of a put, or a seller of a put. And you can be a debit versus a credit trader. So we cover all that in module 1. So even if you have a little bit of experience trading options, I find that a lot of people that trade options, they're only comfortable trading like in one direction. They're only comfortable trading maybe calls or puts. And I find that it's very effective to make sure you definitely review module 1, even if you've been around the block a little bit. Number 2, on module 2, we start getting into the Greeks. Now, the Greeks I like to call kind of like the gauge on your car. Delta, theta, vega, all the major Greeks. You have to kind of look at them to determine what strategy to use, but also, what is the actual option market telling you? So we talk a little bit about, looking at the Greeks and what the purpose is of them. In module 3, we start putting trades together. We start with the basics, just, buying calls and buying puts. And then we talk about being an option seller. We talk about selling calls and puts. But we talk about the risks of obviously being naked, selling naked calls and naked puts. So we talk about the risks, we talk about the rewards, we talk about, some other strategies. Once you have a good understanding of what an option buyer and what an option seller is and what debit and credit means, then we start getting into vertical debit spreads. That's a 2-leg option strategy. But if you'll notice, that's all the way in module 3. So you've already covered a lot of material at that point. You've already had a couple of coaching sessions, a couple of implementation sessions at that point. So you're pretty comfortable with the material. At that point, we talk about how to trade options to capture momentum. So we start talking about faster trades where you can get in and out a little bit faster than a couple of days or a couple of weeks. We talk about module 4 then about we now at this point, we talk about vertical spreads, both debit and credit. And we talk about setting up, screens, optimal option strategy selection, how to set up conditional orders, how to manage risk. All the implementation sessions are built into the modules as well. They talk about setting up your charts, about risk management, about everything you could possibly think of that comes down to options. On top of that, this is what my trade alerts are very detailed, by the way. Just like I set up McDonald's right in front of you, what I do is I give you what I think the edge is. I give you, I give you the difference. I talk about, exactly why I'm picking the strategy. I talk about exactly what the target, entry, stop, and sizing is. If you'll notice, my test is right here: target, entry, stop, and time frame and sizing. So I go into lots of details with my trade alerts, and I talk about exactly when you should implement them. And I give updates as they unfold. So that is what the boot camp includes. You get customized coaching sessions. So again, when we have our coaching sessions during the boot camp, you're going to have plenty of questions, and they're going to be tailored based on what you're experiencing, what's holding you back, what are some of your roadblocks, what are some of the questions and things you might be a little bit confused about. And we talk about all of that during the coaching sessions. Option skills change everything for you. What part of your options trading performance can be improved on? So again, we have a lot of option traders that join us because they want to up their game. They want to have the best option strategy selection. They don't want to just do straight calls and straight puts because they haven't been very successful. Most people that I know that just trade calls and puts they could get frustrated trading options because they don't understand all the mechanics and some of the simple rules to follow that will help you be consistent and successful. And they are simple. They do take a little bit of time to learn and some practice, but with that, you'll be able to be extremely successful with the right training. Midweek updates. So like I said, every Wednesday evening, I give a midweek update. We post the video onto the Discord channel, and you guys will have access to that as well. So the implementation sessions are the bonuses, but basically they talk about screen setup. So even though a lot of you might use different broker platforms, I'll show you what an option chain looks like. We'll talk about how to set up option chains properly, how to look at charts, what type of indicators to look at. We talk about all of that stuff in the first implementation session, including option chains. We also talk about screening. Like I mentioned, I showed you McDonald's, I showed you Boeing. I kind of gave you stocks that I was looking at this week, but basically, I'm going to show you how to set up your own screen so you could screen for your own opportunities. At the end of the day, you want to build out your watch list pretty much on a weekly basis, so you can, you get comfortable with that. Then you're going to calculate your position size. So remember, the last S in tests is sizing. You want to make sure you don't have too much risk for one particular trade. So we talk about what a risk unit is, what is the proper sizing based on the size of your account. There's certain rules to follow, and we go over all of that in the videos as well as the coaching sessions. Secondary indicators as well. Selecting the time frames based on market conditions. So what I showed you earlier in McDonald's, remember, the market conditions are very important. I kind of feel that the market is going to go up to maybe sideways. So my time frame is going to be based on what I think the overall market might do. So I combine those two ideas. I think McDonald's might go higher, but I also think the market's not exactly going to cooperate with it 100%. So I'm giving myself that extra month for my option trade to work. So selecting time frame is extremely important. And this is the kind of setups that you'll learn over and over and over again. We practice in our boot camp and we practice in our coaching calls, as well as with the trade alerts that you're going to get every week, and every single day. Options Trading Pro Discord community. If you can see here, this is not just me in here, it's other traders. It's Michael and Guy. Michael and Guy are basically annual members, and they go in here every single day and they're posting their trades as well. And they're all doing all different kinds of stuff. And you could like ask them questions and interact with them as well. Guy likes to be a credit trader. So he's doing iron condors, as you can see right here. He's doing 4-leg option strategies. So he's one of my students, and he's gotten very good at not just buying calls and puts, but doing really cool strategies and optimizing his best option strategy selection. So that's the most important thing. We also give you a third bonus on order stacking lessons. So these are the people who also want to trade stocks and look at some of the stuff that Pete does on a daily basis. My trades tend to last, days to weeks. A lot of the stuff Pete does could be a little bit faster. And he talks about order flow roadmap, the order flow pyramid, stacking market internals, and sector analysis. So, a lot of what me and Pete does is very similar, but he has other stuff that he wants to show you. So we're giving you a third bonus, which is his order flow stacking lessons, which is really, really important too. So just a quick recap of what you get. It's 14 straight days. Now it's very important. Normally our tuition's $195 for the 14-day boot camp. We are offering 25% off as a Black Friday special. If you use the promo code Black Friday 22, the boot camp will begin on the 28th of November. And again, we also are giving you a bonus. You're going to get lifetime access to your boot camp coaching sessions. So normally after 14 days, if you decide not to become an annual member, basically, we don't include anything after that. We shut everything off because it's just for 14 days. But you get lifetime access. This is the first time we're doing this actually, to the boot camp coaching sessions where you are asking specific questions to your specific needs for that specific time. So it's a great way to review some of the trades that you've done and to practice and to review the sessions. So it is, that's an incredible bonus that we're offering for this week and for the holiday season. So that is my presentation for today. We're going to have some question and answer now, but Pete, I don't know if Pete wants to add anything. If you want to jump in and say anything, it's up to you. But otherwise, I will start taking questions.
Yeah, I think one of the biggest things, John, and we have a lot of feedback from the members of our community on the stock trading side of things, is that the coaching aspect of success is everything. There, even on the stock trading side, but I think even more so on the option side, where everybody knows everything, but not everybody is making money. And right. We spend a lot of time saying what to look at versus how to actually use it, knowing all the option strategies, knowing all the trading strategies versus actually going to the market and expecting to make money every month because you understand how to put together trades that have acceptable risk, but a higher probability of actually making money. So I want to really highlight the significance of the coaching. And we're not exaggerating when we say it's customized coaching. We literally give you the questions to ask based on your current conditions. And it really comes down to everybody if you really want to succeed, I want it really bad. Well, if you want it really bad, you'll spend a little bit of extra time saying, what is really holding me back? What part of options trading do I think I understand, but I'm not actually getting paid? Those are the kind of things that have to really be thought about. Shut your phone off, turn off Netflix, and sit down with the legal pad, write everything down you understand, but then ask yourself, why am I not making money? Those are the questions to bring to the coaching call that you want to have lifetime access to. That is worth 10 times 195, what is it, 149, I think, for this entire package. It's just ridiculous.
Absolutely. If you want to read about options, you can read a book, right? But it's different. It's different between, reading about it and actually making money every month, and knowing what the markets are doing, understanding how to dissect what's happening on a week by week basis, narrowing your focus down to only what's important, and then figuring out what strategy to use. That is where I think we really shine, with our students, with our coaching calls, and with everything else. And, that's how you get results.
One of the things to consider here also is, we have higher tier memberships, and specifically our mastermind group, which is not inexpensive at all. It's up there. People that take action and invest in themselves do not think about the cost. They think about return on investment. If I spend $10,000 on this mastermind group, if I spend $50,000 on this mastermind group, how fast do I believe I can make that money back? And then signing up literally becomes a no-brainer. We're talking about $149 here, and everybody should be asking themselves, out of everything that you just taught tonight and demonstrated to them, how fast can you get that 149 back and a multiple of 10? It's kind of an IQ test at that point, if you believe that what John is talking about tonight is worth many multiples of $149. I could tell you, I'm in some pretty big masterminds. Everybody in that group is known for one thing: taking action and thinking about how fast they can make their money back. That's what it comes down to. And that's really the decision everybody needs to think about tonight. $195 minus 25%. What is that? $149. Is it worth $149 to spend 2 weeks with John and keep the coaching? It's kind of a no-brainer at this point.
Absolutely. It's what you put in, it's a lot of, it's definitely, there's a lot of material, but we give you a lot. We walk you through the whole process. The fact that we give, the coaching calls while you're kind of absorbing the material, I'm there for you at least, about four different live calls we're doing as well during that time period. So you're going to be immersed in this. It'll be a great way to kind of, get you guys started.
I posted 3 questions that were asked in there, John, if you want to knock them out one at a time. Anybody has more questions, you can put them in there as well.
Are they in the chat?
Yeah. Napoleon, Tom, and Charlie in there.
Let's see. I see.
I combined all 3.
Oh, I see him right here. Yep. So when you place the options positions, you go by pattern or the last candlestick. Well, you have to look at everything, Napoleon, but I don't just look at the last candlestick. When you're placing an option, you have to have an entry strategy. So overall, I look at the entire chart. I do full technical analysis. I look at secondary indicators. I look at volume. I look at moving averages. But when I actually place an order, in the case of McDonald's, I'm going to pull it up again really quick here, just so you can see what I'm talking about. What I like, the reason why I think this is an actionable trade now, in my humble opinion, is that it performed a pullback, right? And then today, it actually bounced. So this is what we call a confirmation entry. So Napoleon, what I really like to look at is a confirmation entry. I like to see it pull back after it's been in an uptrend. And what I'll do is I'll let it hit. Now, some traders might want to be more aggressive. They might look at this and jump in here. What I like to do is I like to say, well, I want to see some momentum to the upside before I jump in. So I jump in at a more conservative, at a more expensive price. My option will cost me a little bit more than it maybe did yesterday, but I have confirmation that it's kind of going in the right direction, especially with some pretty decent volume. So the answer to your question is it depends. Some traders that are more aggressive, they'll jump in right when it does this pullback. Other traders wait for that confirmation to make sure that direction is in their favor. And let me tell you something, if you take 1,000 trades, guess what? You're going to be right half the time and you might be wrong half the time. The trick is to be consistent and to have a plan in place. And that's what we talk about in our coaching calls. That's what we talk about in our classes, is to have that plan in place before you go pressing buttons and pulling triggers, right? So it depends a lot on your personality, how many trades you want to get into, how aggressive you want to be, how aggressive do you think the market is. Those are all factors that will add to your decision-making when you decide on an entry price. But I like that chart personally, because in a market that's kind of sideways to up, McDonald's outperformed today. It was up 1.7%. That tells me that people are buying it, right? It's that simple. It's about buyers and sellers. So it's telling me that people are willing to buy it, even in a bad market, even in a market that was down today. So that's why I picked it. So let's see. Next question. From Tom O'Donnell, aside from the single leg option trades, what's the easiest option trade to understand? Well, they're all, once you understand the basics, it's kind of like having, like you ever like go buy it. I always use the drill bit analogy. You ever go to Home Depot and you go to buy a drill set and there's like 50 million different drill bits that come with the drill that you're going to buy? How many do you really use, right? You probably use like 5 of them, right? So the key is to know the basics, know what an option buyer is and what the implication of that means, understand what a net option seller is, and understand what the implication of that means based on the Greeks and based on volatility. And once you have the basics down, then you could start building out double and single leg, double leg strategies like vertical spreads and diagonal spreads. It all becomes very, very simple after that. So it's really about understanding the basics first, understanding the fundamentals. Once you do that, you can start building out trades. It'll be very easy for you to start putting together 2 and 3 and 4 leg strategies once you know the basics. So it's not that hard at all. From Charlie, what's the difference between a call bid and a put ask? Well, I'm not kind of confused about that question. So a call, you're going long. If you're going long a call, you want, buying it on the ask is basically, you're just paying a market order. If you sit on the bid when you're buying a call, you're basically waiting for price to come to you. So again, that depends on how aggressive you want to buy the call option. Now, when you're buying a put, it's the same thing. A put is a bullish trade. So, is a bearish trade. So when you're buying a put on the ask, you're paying the offer side for a short position, basically. So it's kind of the same thing. It's really bid and ask really has to do with what I'll pull up an option chain really quick. I'll probably help explain it a little bit better. Basically, when you look at an option chain, this goes for stocks too, everybody. When you pull up a stock chart is up here. The actual stock price is up here. McDonald's closed at 272.51. The bid was 272.71, and the offer was 272.97. So if I want to buy McDonald's, let's say right this second, let's pretend the stock market was still open, I would have to pay 97 cents. I would have to pay 272.97. Now, when you're trading options, sometimes the spreads are pretty wide. So we talk about this in our classes too, how to place orders. So I wouldn't necessarily want to lift this offer at, let's say, 287. I might want to place an order somewhere in the middle, maybe 265 or 270, and I'll let it sit there for a couple of minutes and see if anybody takes it. Or you could sit on the bid and hopefully maybe someone will come and aggressively sell you some. That could happen too sometimes. But again, it's a matter of urgency. How urgently do you want to get into this trade? That is really what you have to ask yourself when you're deciding whether you want to buy on the bid or buy on the ask, whether it's options or stocks, right? I mean, there's really no difference when it comes to that. So let's see. Do you go over roll? We sure do. Going over rolling up and rolling down. I've heard people talking about it. Yeah, so rolling is one of the strategies. So whenever you have a 2-leg option strategy, Tom, you have to kind of make decisions around your expiration dates as to what you want to do. So if you have something like a McDonald's diagonal spread, like I illustrated, you're short the two. So back to McDonald's, you're short the 280s, right? It's trading at 272. You're short the 280s on December 2nd. So if December 1st, let's say, rolls around and it gets closer to expiration, hopefully that option value deteriorated a little bit, because remember, time is kind of working in your favor. For the short leg, you're going to actually start making money there. Now, if McDonald's decides to stay at around 280, you're going to collect that full premium. If it goes higher, you might have to close that position out a little bit early. You're still going to make a little bit of money, and you're also making money, don't forget, on your long leg, the one that you don't forget, you own the December 16th 270s, right? You made a lot of money on that trade at that point. It went, these McDonald's went from 272 to 280. So those 270s are worth a lot more than they were when you first bought it. What I'm talking about is that short leg. You have to decide whether you want to do a roll, like you said. So you could roll it out to December 16th and pick your highest strike price. That's what rolling is. And if you do that, Tom, guess what happens? You take in the credit from the 280s, and let's say you roll to 290 because McDonald's is still in an uptrend. Now, guess what you did? You lowered your cost basis from $7 down to $6, down to $5, let's say. On top of that, you collected 2 credits and not 1. So these are all strategies that you would implement using best option strategy selection. And that's the key. That's why so many option traders are not successful, because they don't know how to do this stuff. They just buy calls and they watch their trades kind of disappoint them. They might make a little bit of money, but not as much money as they should have. So yeah, rolling is, we definitely talk a lot about rolling, that's for sure, because one of the decisions you have to make. So on average, how long do you hold your trades? I usually decide before I get into the trade, that's one of my criteria, Lou. I decide what my time frame should be based on what the chart is telling me. So in the case of McDonald's, I think it's going to take a couple of weeks because it looks like it's going to go sideways for a little while, and the market's kind of going sideways. But what if the market was an A plus? What if the market was going straight up? I might be in the trade shorter. So sometimes I'll bail out of a trade a little bit early, but I always want to set up my trades to the appropriate time frame based on ATR, based on average true range of the stock. How quickly does the actual stock move, and then how quickly do I expect the stock to reach my target? Those are my factors when determining time frame. It's Joe. So is mostly self-study with daily coaching? What time frames daily? So with daily, so basically it's combined. So Pete could jump in here too, but what's great about our program is that a lot of it's self-study. We obviously give you all the materials, all the recordings, but it's also live. We give 4 live sessions during those 2 weeks, as well as the Discord channel, as well as the trade alerts. So it's a little bit of both. So it allows you to absorb the material at your own pace, and then you could ask questions that are specific to your needs during that time. So it's a little bit of both. And that's the cool thing about it. And time frames change. So yeah, some time frames, if I'm doing a momentum trade, I might only be in it for a day. If I'm doing, most of my trades, I tend to do swing trades. I have a money management background, so I'm very comfortable holding 20, 30 things at the same time. That might overwhelm some people, but I'm kind of comfortable holding smaller positions, but a lot of different things going in different directions. So, that's kind of my style. Some people only hold 5 names or 10 names. It really depends on your personality, how much you're willing to risk, and what your overall, what your overall style is. And that takes a little bit of time to master. That's where your trade plan comes in. That's where practice comes in. I encourage you all to open up an account and open up a simulated trading account and start trading. You don't have to spend. What's great about now, 20 years ago, you'd have to lose money in order to trade, in order to learn, right? Now you could actually spend a couple of $100 on a brokerage account and have simulated trading. And you could trade 1,000 trades and really become an expert at certain, at yourself, at your plan, at your own strategy. And what's cool about it is, you won't put any money in harm's way until you're ready. And that's really, really cool about the technology that we have now. In the old days, that was not the case, unfortunately. I had to pay my tuition in a lot of ways that way. But now you're very lucky. So let's see what other questions. On average, how long? Let's see, assuming that your coaching session times don't conflict with Pete's. So I don't think they do, Pete, do they? I'm on Tuesday.
Nope, we're on different times.
Yeah, so yeah, they don't conflict at all. So and everything's recorded, by the way. So you could always write things in Discord if you miss something, or you could put something in the forum and I'll catch it the following week. There's always ways to reach out to me if you miss a coaching call. So don't worry about that.
John, I just wanted to touch on something that you had mentioned before, where there was a question and you said it depends. I think that is such a huge statement that a lot of people miss. And that's the difference between somebody who becomes profitable and understands that trading is a skill to learn versus just reading the book and thinking everything is going to look like the book. It depends is the $1 million question of the entire point of coaching and having different market conditions that you trade together, because the market is not what it looks like in the book on page 52. And do this. It's always
Yep.
changing before and after. That's what coaching is for.
A lot of people want rules. I understand sometimes not the frustration, but definitely people want, specific rules. If this happens, this is what I should do. If that happens, this is what I do, right? That's not how trading works. I wish it worked that way.
Yep.
There's market conditions that are a factor, and you have to develop a process that's flexible and fluid, but is still a process that allows you to have an edge. And that's what I've managed to master over the last 20 years. It took this long because I kind of had to start from scratch. You really want to, you want to have a simple strategy that fits what you're doing and fits your personality, and it's flexible. So my strategy is great because if the market changes, I'm just going to start buying more bearish trades. Like I told you, I was like a B plus on Monday. I'm now like a solid B because of what happened today. So I downgraded a little bit. So what that means is I'm going to add a couple of bearish trades tomorrow. I'm going to be looking for some bears just to kind of offset some of the bulls that I put on earlier this week. So that's kind of how my strategy works. And I'll pick the right strategy. Sometimes I'll pick a more conservative option strategy versus a more aggressive one if I want to just add something without taking on too much risk. So it's all about risk management. It's all about managing your overall, your overall risk, and what's happening in the markets has a lot to do with that. So any other question? I missed anything? Oh, there's more. Whoop, we got a lot more here. So momentum trading, sometimes with options, when you go out 30 days or more and in the money, the volume with a low. Yeah, so volume could be a problem sometimes, but Pamela, that's a great point. Let's see. So I focus on the volume for my trades. What are your thoughts? So Pamela, for momentum trading, here's the cool thing about momentum trading options. If you go down to the weekly options and you start, once you get some experience, I don't recommend this for brand newbies, right? You want to kind of leave some time. You want to go out at 30 days for the most part. But if you're going to do momentum trading, what's cool about everything that I showed you was if you're going to pick a market direction, you don't have to pick a specific stock. You could trade QQQ, you could trade SPY, you could trade SPX, you could trade a specific sector. So let's say I wake up in the morning and I'm like super bullish, and all of a sudden the semiconductors completely blow up, right? What I'm going to do is I'm not going to necessarily try to figure out what stock I should be going short. As an options trader, I'm just going to buy SMH puts, and I'm done. And that'll kind of offset, all my longs that I might have had, right? So there's ways options are used to hedge, and there are also ways options are used to do those momentum trades. So when it comes to volume, Pamela, my answer would be don't necessarily try to go to a stock, right? You could pick a sector or an industry group in the ETF market, which will give you plenty more liquidity if you want to try to add a bull or a bear. Depending on what strategy you want to use. Okay.
John, I just want to answer one question. Somebody was asking about signing up after in December. I just want to make this clear to everybody. The next time that this offer is going to be available with the 25% discount and the $199 coaching bonus will be November of 2023. Next year.
Yeah.
So this is a very limited time Black Friday offer in November of 2022. So just want to be clear about that. If you're waiting for this again, you're gonna have to wait a year.
And I think William had a question about what happens after the 14-day boot camp.
Yep, we have our team has a meeting with everybody to determine if we're a good fit to move forward to the next step,
which would be annual membership.
Correct.
Yeah.
But we have to have an interview. Not everybody's a good fit for the program. We need to make sure that people are coachable and they actually have a desire to learn.
Absolutely. So available class every day during market hours for this boot camp, or is it during my own? So Frank had a question about hours. Boot camp is so you'll have 14-day access to all the material. The coaching sessions are usually in the evening. They're in the evenings at 6:30, like tonight, for instance. So most people, we understand that most people have full-time jobs. So all the recordings are there for you to watch on the weekends or at your leisure, whenever you want. And then for that 14-day period, and then the coaching sessions are generally in the evenings, but they're all recorded. So even if you miss one coaching call, it's not the end of the world. You'll actually get the recording as well. Okay. Let's see. I'm just going.
The big thing to think about here, John, I mean, obviously we got a lot of really nice people on the call tonight that have a desire to trade options. And really what it should be coming down to right now is you showed them tonight what you do, that you know what you're talking about. Right now, it really comes down to, is $146 worth a lifetime skill to trade options the right way? That's really what it comes down to. Is the $146 investment worth it for them to invest in themselves right now? That's really what it comes down to. And action, people who take action, they do it right away.
Yep. So you answered Raymond's question. I'm just looking at all. I'm just trying to. I don't want to miss anybody's question here. I'm just going through.
I think we got the ones that are in there. I typed them in or I answered them myself.
Okay, cool. So yeah,
Bulgaria, look at that. We got people all over the world.
That's awesome, Boyan. I hope I said your name correctly, but welcome. I'm glad you joined us. So yeah, if there's any other further questions, we are here. And I hope this was I hope this was helpful. I hope you enjoyed it. Like I said, it's a lot of material, but the way we teach it, the way we show it, between the coaching calls, the community, as well as the recordings, it's a fantastic combination to learn. So with Black Friday, oh yeah, a lot of pretty soon that Mariah Carey song is going to be in my head.
Oh God, please no.
Yeah. Can't we just enjoy Thanksgiving first? That's what I tell people, but obviously, I mean, I'm here down in Miami and they already have Christmas trees up. It's insane. It's like 85 degrees out and it is full-blown Christmas already.
Wow.
So once we join the who follows up with us. So Pamela wanted to know who calls her after the 14 days are over, basically. Mm-hmm. She just wanted to know who would contact her.
Our support team schedules a call.
Got it.
You don't have to sign up tonight, but obviously we'd prefer you did. This is, again, if you click through to the page, you'll see that the bonus expires on the 21st. So you need to at least sign up before the 21st. Which is 5 days.
See how futures look while we're sitting here. It looks like we have a green day so far. Yeah, just kind of sideways and choppy this week. We'll see what happens tomorrow.
All right, I'm going to type this in here one more time. If anybody has any final follow-up questions for what it's like in John's coaching program, type them in now. And you got John live. You might as well ask the question now, right?
Yeah, I mean, so glad to hear
Pamela.
Pamela, I'm looking forward to speaking more with you. I'm looking forward to it. Absolutely. But here's the thing, trading, and I'm sure Pete agreed with me on this one. Trading is a lot more of a mental game than people realize too. So to be able to just have these coaching calls, it's almost like, it's partly like a psychology call. You're talking about frustration and things that might cause a roadblock for you. Maybe certain things you just don't understand. That might be one thing that you just don't get, that you're frustrated with. That's what's great about these coaching calls. And it's a fantastic community. Our members are some of the nicest people. They help each other. So besides just me, you're getting a whole community of people, like-minded people just like you, who want to do well, who are helping each other, who are asking questions. Our coaching sessions, I really enjoy them. The hour goes so fast. I mean, it's just it's amazing just to be able to talk to people and to try and help them, and really this is a subject matter that I think is very important. Obviously, it's my passion, but it's not really well covered in the market. It's not really well covered in school. I didn't learn this stuff in school. How to trade, how to pick ideas, how to come up with a good strategy selection. That's just stuff that that they don't teach. So what's great about our community is the fact that we bounce ideas off of each other, and we're all here for each other, including the specific questions you guys have.
All right, we're going to wrap it up with Tom's question here. I've heard of the term being delta neutral. Do you touch on that?
Yeah, delta neutral is an important concept. So when you learn the Greeks, basically a positive delta, right, means that you're long, right? So stocks have a delta of 1, Options generally, have a delta of less than 1. So when you're delta neutral, that basically means that you're like long and short, your calls and your puts basically equal 0. So being delta neutral means your portfolio is neutral. You have just as many longs, or you have just as many long exposure as you do short exposure. So being delta neutral allows you to sleep at night, basically. And that's what a lot of money managers do. They'll try to be delta neutral in their portfolios overnight to avoid, geopolitical or any kind of risk that might be going on, at the time. And
John, you've been teaching options trading for a long time, but you've also been trading options for a long time. Got a lot of people are going to be watching this video, people that are on here right now, trying to make that decision, right? What's the difference between somebody who finally gets to the other side or somebody who's going to be continually trying to figure it out and never figures it out? What's the difference?
I think the main difference is understanding markets on top of the textbook stuff. You know what I mean? Anyone could read a book on options. You could learn it in a classroom from a teacher, et cetera. But finding actionable trades in real life, real time situations, being able to manage your emotions, manage your risk at the same time, being able to take your opinion and stuff it under the closet. Stuff it in the closet, right? When the market is telling you something completely different, it is very hard. Develop those type of habits. Teacher, that's not what a teacher could teach you. Traders have to teach you that, because traders have to learn how to balance their emotions with what the markets are telling them, their opinions with what the market's telling them. I joke around like there's a difference between cocktail talk and what I'm going to be doing tomorrow in the options market, in the stock market. Like I might have an opinion as to inflation, an opinion on the economy, an opinion on everything really. But basically what I might be doing trading wise might be completely the opposite. And the quicker you're able to do that, the better. The quicker you're able to apply that. And that's something they don't teach. That's something, that only someone with trading experience is able to master and to teach other people. And I think that's what makes us a little bit, makes us different. Being a trader who happens to teach every once in a while is a lot different than a teacher who does a little bit of trading.
Mm-hmm. You have to have skin in the game to really understand. Textbook is very, very different from consistency. Very, very different.
Absolutely.
I've written some of those books. Sometimes you can take a week to find the 5-minute bull flag you're going to put in the book.
Yes.
The perfect textbook one. That's not real trading. That's information. There's a difference between information and skill.
Hey, you can always draw one, Pete. You know what I mean? If you can't
I'm not very good. My wife is a good artist. I'm not.
This is what a bull flag looks like. And in real life, it won't always look so pretty, right? So you have to make calculated decisions, and again, finding your own, learning your own habits, learning your own personality is key to being a good trader too. A lot of it is psychology. You have to understand who you are as a person and how are you going to react to what the market gives you, because the market is going to give you everything in your career. It's going to give you up, sideways, down, reversal, manic, depressive, boring. It's going to give you everything. It's going to give you everything you could possibly imagine, and you have to manage your emotions through all of it. So that's the key, and it could be challenging, but it's fun. I love it. That's the fun part of it.
All right, I guess we'll wrap it up. Looks like we got everybody's questions. Thank you everybody for attending tonight. Hopefully, looks like a lot of people have signed up actually already. If you're on the fence right now, John mentioned inflation before. So right now, the cost of the 2-week boot camp is the same price of a dinner that will last about 90 minutes. So sounds like a pretty good trade-off to me to get started.